Welcome to the Palantir Crucible. We are the Doubtful Investor, and today we cut through the noise surrounding one of the most polarizing infrastructure plays in the market. Let's start where the fear is, the recent 33% drawdown. The market has reacted violently to short-term data, but the true analytical investor must look deeper. This is the Doubtful Investor, where we filter out the narrative and focus strictly on the financial signal. Our aesthetic is dark, serious, and numbers-focused, reflecting the gravity of the assets we analyze. Don't forget to like and subscribe. Turn on notifications so that you never miss a video. Palantir's stock, trading under PLTR, has experienced a brutal 33% correction. For many, this signals distress. For us, it signals opportunity, but only if the fundamentals validate the long-term thesis. Before proceeding with this deep dive, a necessary disclosure must be made. Full disclosure, I hold a long-term position in this asset. We view this drawdown not as a defeat, but as a gift. It is a moment for patient investors to acquire an asset at a discount, focused entirely on hard numbers over fleeting market narratives. To understand the core strength of Palantir, we must move past simple growth stories and focus on operational efficiency. We are about to see Palantir shatter the most respected metric in enterprise software, the Rule of 40. We are pivoting our analysis to the Q1 2026 financial metrics. This quarter was not just an incremental improvement, it was a fundamental financial turning point. Palantir delivered total revenue of $1.633 billion. This represents a staggering 85% year-over-year growth, demonstrating accelerating adoption across government and commercial sectors. The Rule of 40 score reached a historic, industry-leading 145%. This single metric confirms Palantir's extreme operational efficiency and proves it is no longer a growth-at-all-costs venture. A Rule of 40 score at this level places Palantir in the same elite infrastructure tier as NVIDIA. They are not merely selling software, they are establishing a foundational, high-margin operating system. We now drill down into the margin layer, the operational profitability that separates market leaders from mere pretenders. The focus here is not just on revenue, but on how efficiently that revenue translates into bottom-line profit. This is the true measure of a moat. GAAP net income soared to $871 million, translating to a staggering 53% net profit margin. Profitability this deep is unprecedented for a company at this stage of growth. Furthermore, adjusted earnings per share came in at 33 cents, decisively beating Wall Street's consensus expectation of 28 cents. This demonstrates operational discipline and conservative guidance. Total contract value, or TCV, increased by a robust 61% to reach $2.41 billion. This metric is critical as it forecasts predictable future revenue streams. Due to this accelerating momentum, management aggressively raised its full-year revenue guidance to 71% growth. This is a clear signal of immense confidence from leadership. We now come to the conclusion of our analysis: why the market continues to misprice this foundational asset. Palantir possesses a formidable $8 billion debt-free cash fortress. This financial immunity provides unparalleled flexibility and insulation against macro volatility. Crucially, they maintain a sovereign defense monopoly, a position nearly untouchable by typical commercial software competition. Their government contracts are a structural, durable advantage. In summary, the market is irrationally treating an elite operating system, defined by extreme efficiency and foundational defense contracts, like a weak, highly competitive subscription app. The numbers tell a different story. This has been the Doubtful Investor. Remember, always be searching for signal over noise.